Investors in Yahoo may be feeling a bit of whiplash today. After the bell, the company reported better than expected results. Today, though, the stock is down. Deb Marchini is here with a look at the reasons why. It's what makes Wall Street so quirky, Deb.
And interesting. If there ever was a case to confuse investors, Rhonda, this is it. Yahoo lost ground yesterday, closing down 51 cents at $12.19. Then after the bell, the company reported earnings of 3 cents a share, a penny better than expected. In after-hours trading, the shares jumped, hitting $12.54 in European trading. Then the bombshell. Merrill Lynch cut its short-term rating on the stock from neutral to sell and cut its long-term rating from strong buy to neutral, saying Yahoo is overpriced. The ratings cut was especially surprising considering that just yesterday, Merrill accurately predicted that Yahoo would report a better quarter than expected. At that time, it reiterated its neutral rating on the stock for the short term and kept its long-term rating at a strong buy. Why the change a day after better than expected earnings? Well, it says sales growth was generated by new businesses, not Yahoo's core business of online advertising. Merrill also says the stock is priced to perfection and that a more reasonable valuation would be $9 to $10 a share. That's lower than where it's trading now. In cutting its ratings, Merrill's going it alone. U.S. Bancorp Piper Jaffray raised its rating on Yahoo to outperform this morning. Bear Stearns reiterated a buy. Soundview Technology maintained an outperform rating and a $20 price target. Prudential Financial and CSFB reiterated a hold. Prudential with a $14 price target. But for now, Yahoo is trading lower this morning. The stock down 44 cents to $11.75, and investors are left to wonder who's right. Rhonda?
Deb, thanks so much. What we want to do now is find out a little bit more about what's going on with Yahoo stock and earnings from the company's chief financial officer, Susan Decker. She joins us from Yahoo headquarters in Sunnyvale, California. It's good to see you once again, Susan.
Thank you. It's great to be here.
And I think we should congratulate you on the quarter because you did move ahead as planned, so that would be a positive from your perspective.
Well, thank you. We're feeling really good about it. We outlined a number of plans 6 months ago, 8 months ago, and we feel like we delivered on a lot of the things we said we were going to do in terms of revenue diversification and adding some new businesses that will really add to growth long term.
That diversification, of course, means that you want to wean yourself off of a dependence on ad revenues, especially since we know many media companies have suffered with the advertising slump. Are you done now with that change of focus? And I believe I asked you this last time you were on. If things turn around, do you reshift and look again at what those ad revenues can do for your bottom line?
Let me just say that we are very positive about the advertising potential of the internet. The only part we're trying to wean ourselves off of is the .com exposure from companies that we thought might not be in business long term. But we've really supplemented our marketing capabilities by not only servicing some of the largest companies in America in their branding and other objectives, but also we added a very significant component of small and medium-sized businesses to our roster. So one of the really exciting things is that this quarter was a symbolically important one in the sense that we now have all of the legacy business that was disappeared as part of the yesterday's news behind us, and we're looking at positive double-digit comparisons in our marketing spending in the second half of this year.
Susan, Jim Wagner, Pace Capital here. Big picture question. Retail spending on the internet is up, by some measures by as much as 40% in the last 12 months. Advertising spending is starting to inch higher in certain media. But when is the internet going to get something that's appealing to the user? Banner ads prove to be useless. These pop-up ads are proving to be more than useless. They're downright annoying. Somehow, some way, they've got to get it right. What's your take on this?
You know, your start of the question was exactly the point, that users and usage continue to grow on the internet. More commerce is happening, more people are transacting and finding things on the internet. One of the complex issues about advertising on the internet is it really depends on which segments a company is exposed to. A year ago, a lot of our business was coming from .com companies that were buying banners, which, as you point out, didn't, in the long term, provide the value they were paying, and many of those business models have deteriorated. By contrast, today we have added sponsored search capabilities. We've added, through the acquisition of Hot Jobs, a careers business. These are very vibrant businesses that have attracted much more significant share of advertising on the internet than is even spent offline. So one of the fascinating things is that if you look at the contribution that small businesses make to the economy in America, and it's a much bigger percentage than what they contribute to advertising because they simply haven't had a vehicle that's economically attractive to them to get to their users to their customers in the past. So we feel like we've transitioned to be in the most attractive sectors of advertising, which is why we're seeing such strong growth.
And when do you expect to see that the Yahoo ad revenues will begin to pick up?
Oh, we do apologize for that. We have lost that feed with Susan Decker, so we do apologize. We'll try to get that squared away, and if we do, we will continue that interview with Susan Decker.